Welcome, everyone, to a brand new deep dive.
Great to be here.
Before we really get stuck into things today, please take a second to like the video, subscribe to the channel, and comment down below with your opinion on what we discuss. We always love hearing your thoughts.
Absolutely. The comments are always an interesting read.
They really are. So today we are tackling the gold and silver markets. And to help us unpack this, I am thrilled to introduce Senior Market Analyst Dr. Khalid Al-Nuaimi.
Thank you. It's a pleasure to join you for this one.
So when you picture investing in gold, you probably, you envision a massive 400-ounce bar just sitting quietly in a vault somewhere.
Just gathering dust.
Exactly. It is supposed to be the ultimate financial anchor, the thing you drop to stabilize your portfolio when the rest of the world gets a bit stormy.
Right.
But I mean, if you were watching the charts on the evening of June 26, 2026, that anchor was nowhere to be found.
Not at all.
Instead, gold looked more like a bungee jumper stepping off a bridge. We saw this terrifying, stomach-dropping free fall, and then instantly followed by a violent, whiplash-inducing snap back up.
Yeah, it was the absolute definition of market whiplash. Just a completely chaotic trading session. It left a lot of institutional and retail traders honestly questioning the stability of the entire precious metals sector.
I can imagine. So our mission today is to make sense of this. We have got a stack of urgent market bulletins and strategic investment analyses, and we need to figure out exactly what is pulling the strings right now. And more importantly, how you, the listener, should position yourself amidst all this chaos.
Spot on. That is the million-dollar question.
Let's start with the anatomy of this massive $100 swing. So gold opened under intense selling pressure. I mean, it crashed right through the critical $4,000 an ounce mark, bottoming out around $3,965.
And, losing that $4,000 floor, it is not just a technical footnote.
Right.
That is a massive psychological and institutional threshold. When an asset breaches a round number support level like that, you typically see liquidity completely vanish.
Because everyone just steps back.
Exactly. The order books thin out, and the price just cascades downward.
But that is the crazy part to me. The cascade didn't happen. Suddenly, around 7 in the morning, it is like a switch flipped.
Yeah, the dip buyers arrived.
Massive dip buying. Traders saw that sub-4,000 price and pounced, propelling gold all the way back up to $4,050 an ounce by the evening. So does this bungee snap mean the market has found its absolute floor? Are we safe now?
Well, what's really fascinating here is the sheer velocity of that reversal. It points to a market driven by extreme algorithmic sensitivity.
Okay.
We're likely looking at a massive short covering rally. So the algorithms that drove the price down to $3,965 hit their profit targets, right?
Cash out.
Exactly. They bought back their positions to close out, and that sudden surge in buying volume forced the price back up. It shows there is deep-pocketed institutional interest waiting in the wings at those lower levels.
But it doesn't mean the environment is safe.
Oh, certainly not. The volatility proves the market is incredibly fragile right now.
And silver was doing the exact same volatile dance, wasn't it? But with even more extreme percentage swings.
Oh, silver always exaggerates the moves.
Right. It dropped down to $55.70 an ounce before violently rallying back up to $58.30. A $3 swing in a matter of hours.
Which is huge for silver.
It is massive, which tells me we aren't just looking at isolated panic in gold. We are looking at macro forces tossing the entire metals complex around.
Yeah, you have to remember, gold and silver don't exist in a vacuum. They are constantly reacting to the broader macroeconomic environment.
And what's dominating that environment right now?
Right now, it is aggressively dominated by 3 factors. You've got treasury yields, the strength of the U.S. dollar, and the Federal Reserve's monetary policy.
Okay, let's look at the data our sources provided for that specific day, because on the surface, the numbers look incredibly bullish for metals.
They really do.
The U.S. dollar index, the DXY, actually dipped slightly to 101.2. The 10-year U.S. Treasury yield cooled down to 4.39%.
Both usually great for gold.
Right. And we also saw crude oil prices drop. WTI was down to $70.14, Brent at $73.57 a barrel. And to top it all off, the latest PCE data, the Personal Consumption Expenditures Index.
The Fed's preferred inflation gauge.
Exactly. It came in exactly in line with expectations. It didn't spike.
And a cooling PCE combined with falling oil prices should, theoretically, ease long-term inflation fears.
So make it make sense for me. If inflation is cooling, oil is down, the dollar dipped, and yields backed off, gold should be launching.
It should be, yeah.
Yet our sources show gold was actually heading for its fourth consecutive week of losses before this sudden bounce. It was sitting near a 7-month low. Why is the market punishing gold when the immediate data looks so favorable?
Well, if we connect this to the bigger picture, it really comes down to the mechanics of real yields and opportunity cost.
Okay.
Think of high interest rates as gravity on a non-yielding asset. Gold doesn't generate its own thrust. It pays no dividend. It offers no corporate buybacks.
It sits there.
Exactly.
Yeah.
So every time the Fed dials up the gravity by keeping rates elevated, gold gets pulled back down to earth.
Because holding a risk-free treasury bond paying 4.39% is simply too attractive for institutional capital.
Exactly. Compared to holding a shiny rock that costs money to store in a vault, bonds look like a much safer bet. The dollar may have dipped to 101.2 for a few hours, but zoomed out, it is heading for its strongest month in a year.
Wow.
Furthermore, the market is currently pricing in a potential interest rate hike in September. The Fed is maintaining a highly hawkish posture because they are just terrified of inflation rebounding.
So as long as the market believes the Fed will keep rates higher for longer, institutional capital just parks itself in cash or treasuries.
Yes. And that puts a heavy, undeniable ceiling on gold's price.
So even though the PCE data didn't show inflation accelerating, it also didn't give the Fed any justification to suddenly pivot and slash rates?
Right. The hawkish gravity is still fully turned on. And every time a Federal Reserve governor steps up to a microphone and hints at keeping monetary policy tight, you're going to see these algorithmic spasms in the metals market.
They just react instantly.
Capital instantly reprices the probability of a rate cut, and gold takes a hit.
Which brings us to a major debate in the strategic analyses we are looking at today. Knowing that this Fed gravity is still holding gold back, we have to evaluate the nature of today's dramatic recovery.
Yeah, was it real or not?
Exactly. Was that explosive snapback up to $4,050 the beginning of a new bull run, or just a temporary mirage?
Well, the consensus across the institutional desks is overwhelmingly cautious. They are categorizing this strictly as a technical bounce.
Meaning traders bought the dip purely based on oversold chart conditions.
Exactly. Not because the underlying macroeconomic story actually improved. When an asset drops for 4 consecutive days and collides with a major psychological support level, like $4,000, technical traders and algorithms step in.
They see a bargain.
They buy because the mathematical indicators suggest a short-term overreaction. It is essentially a relief rally. But, a relief rally is very different from a confirmed trend reversal.
Because a reversal would need real momentum.
Right. It would require sustained buying pressure over several weeks based on shifting fundamentals.
And the sources point out a massive headwind preventing that sustained buying pressure right now, which is sector rotation, specifically into the tech sector.
Oh, absolutely. Investors are completely captivated by the AI boom right now.
Yeah, capital that might historically flow into safe haven assets during periods of uncertainty is instead being vacuumed up by massive tech multiples.
It is a hyper-aggressive risk-on environment in equities. I mean, when the broader market is chasing double-digit returns in artificial intelligence and semiconductor stocks, a defensive asset like gold gets orphaned.
Left behind.
Yeah, portfolio managers are actively draining liquidity from hard assets to chase the tech rally.
Now, here's where it gets really interesting for the technical folks. The technical analysts in our stack of reports are warning about a pattern on the gold charts called a death cross.
Yes, the death cross.
It sounds like a professional wrestling finishing move, honestly, but I know it is a serious technical indicator.
Yeah.
Break down the actual mechanics of a death cross for us and why it triggers such aggressive selling.
Well, a death cross occurs when a short-term moving average, typically the 50-day, crosses below a long-term moving average, like the 200-day. Now, it is technically a lagging indicator, meaning it just confirms a downtrend that is already happening. But its real danger lies in its role as a systemic tripwire.
A tripwire for algorithmic trading bots.
Exactly. Modern financial markets are heavily dominated by quantitative funds and algorithmic trading systems, and they're programmed to execute automatically when certain technical criteria are met.
So no human is even making the call.
Right. When that death cross prints on the daily chart, it trips a wire. Algorithms automatically dump paper gold contracts into the market.
Wow.
And that sudden flood of supply triggers the next layer of stop losses, which triggers more selling, and it creates this self-fulfilling avalanche.
So if gold loses that $4,000 support level again and actually closes the daily candle below it, we aren't just looking at a slow bleed, we are looking at an algorithmic trapdoor opening up.
And the sources are explicitly warning about that scenario. Right now, gold is trapped in a highly volatile battleground. The absolute floor is that $3,970 to $4,000 zone.
And if we breach that?
If we breach that, the selling will accelerate rapidly. On the upside, the short-term resistance ceiling sits between $4,050 and $4,080.
So until it breaks out of there, it's just stuck.
Exactly. Until gold can smash through $4,080 on high volume and hold it, this current price action is just noise inside a broader downtrend.
I'll be honest, staring at these daily charts and worrying about algorithmic tripwires feels like staring at the choppy surface of a storm. It makes you slightly seasick.
It does, yeah.
But as investors, we need to look at the underlying currents. So let's pivot to the golden horizon, the long-term macroeconomic outlook for precious metals.
And this is where the tone of the institutional reports completely changes.
It's night and day.
It really is. Despite the immediate threat of death crosses and Fed rate hikes, the long-term outlook from our sources is exceptionally bullish, with projections of new historical all-time highs in the coming years.
To understand that, we really have to separate the cyclical forces from the structural forces. The gravity we talked about earlier, a strong U.S. dollar, high treasury yields, the Fed's current hawkish posturing, those are all cyclical, right?
They are entirely cyclical. Interest rate regimes go up, and inevitably they come down.
Whoa.
When the global economy eventually slows down under the weight of these high borrowing costs, the Fed will be forced to pivot. They will cut rates. And the moment that cycle turns, the heavy anchor holding gold down is removed.
And the opportunity cost of holding non-yielding assets vanishes.
Precisely.
But the forces currently supporting gold's long-term thesis, those aren't just cyclical swings, they are massive structural shifts in the global economy.
Massive.
The reports highlight soaring global public debt as a primary driver. Governments are issuing debt at a pace that is historically unprecedented outside of major world wars.
And that debt issuance mathematically limits how long central banks can keep interest rates elevated. I mean, if rates stay at these levels, the interest payments on that sovereign debt will consume entire national budgets.
Which they can't allow to happen.
Exactly. This forces an eventual return to liquidity injection and currency debasement, which is the exact environment where gold thrives as a store of value.
Then you layer on the geopolitical landscape. We're seeing fracturing global supply chains, trade tariffs, escalating regional conflicts. But the absolute heaviest hitter in these reports is the trend of de-dollarization.
Yes, and this raises an important question about global monetary architecture. You see, de-dollarization isn't just a political buzzword anymore.
It's actually happening.
It is a mechanical shift occurring in real time. We are seeing sovereign nations actively diversifying their foreign exchange reserves away from U.S. treasuries.
Yeah.
They are setting up bilateral trade agreements that bypass the SWIFT system entirely.
And what are they replacing those dollars with? Physical gold?
Exactly, physical metal.
I do have to push back on this a bit, though. The central banks that are quietly hoarding thousands of tons of gold are the exact same institutions that manage the global fiat currency system.
Right.
Isn't that a massive inherent conflict of interest? I mean, they are aggressively keeping rates high to defend their fiat currencies while simultaneously stockpiling the ultimate hedge against those very currencies.
That is the ultimate paradox of the current financial system. Honestly, central banks are essentially front-running retail investors.
Wow.
They are using the current environment of high interest rates and a strong dollar as a smokescreen. Because paper gold prices are suppressed by high yields, sovereign banks can accumulate massive physical reserves at a relative discount.
And they aren't logging into a retail brokerage app to buy it. They are acquiring it through over-the-counter markets and sovereign swaps.
Dark pools, essentially.
Right, completely dark pools that prevent their massive buy orders from spiking the spot price on the open market.
Exactly. Central banks don't care about a short-term death cross on a 50-day moving average. They're executing a multi-year strategy to insulate their national reserves against the eventual devaluation of fiat currencies. They are buying insurance against the system they themselves operate.
Which is proper scary when you think about it.
It is very sobering.
So what does this all mean for you, the listener, who doesn't have a sovereign wealth fund at your disposal? How do you actually navigate this volatility based on the strategic playbooks in our sources?
Strategy is everything right now.
Especially when we're seeing $100 intraday swings. Let's start with the long-term accumulators. What's the play?
For the long-term accumulator, the directive is ruthlessly boring. You stick to your dollar-cost averaging plan.
Just keep buying steadily.
Yes, if you buy into the structural thesis of de-dollarization and global debt expansion, you have to completely ignore the daily noise. These sharp technical drops are just opportunities to acquire more ounces at a lower cost basis. You're basically playing the same long game as the central banks.
Okay, fair play. But what about the investor who got caught off guard? The person who bought heavy a month ago, right at the top, right before this massive 4-week slide began. They are looking at their portfolio right now, and the urge to panic sell must be overwhelming.
Absolutely. But the absolute strongest warning in these reports is against panic selling at these levels. The price has already violently retraced to a major historically defended support zone around $4,000.
Right.
If you sell now with the intention of trying to catch a slightly lower dip at $3,900 to buy back in, you are playing a very dangerous game of institutional chicken.
You risk getting completely whipsawed.
Exactly. Because if the market suddenly gets wind of a softer Fed stance or an unexpected geopolitical shock occurs, gold could gap up $50 in a matter of minutes.
It moves that fast.
It does. And if you panic sold at the bottom, you have just locked in your losses and you will be forced to buy back in at a premium. Patience is the primary defense mechanism if you're currently underwater.
Makes perfect sense. Now, what if you are sitting on cash on the sidelines right now, looking for an entry point?
The strategy for capital deployment right now is tranche buying.
Okay, meaning?
Meaning, do not take your entire cash position and dump it in at $4,050, hoping you nail the exact bottom. Break your capital into smaller chunks.
So you buy a little bit here, and you set limit orders further down.
Yes, stagger your entries. Place limit orders down near that $3,970 floor. That way, if the algorithmic tripwire does trigger another sudden flush, you actually have dry powder ready to automatically capitalize on the panic rather than being a victim of it.
Brilliant strategy. And finally, let's address the active traders, the adrenaline junkies trying to play this day-to-day chop.
Well, for short-term traders, the current environment is strictly for scalping small technical bounces. You get in, you take your profits quickly, and you get out.
Don't linger.
Exactly. The overarching macro trend is still under pressure from the Fed, so this is not the time to build massive swing trade positions hoping for a breakout. Interestingly, the institutional analysts strongly recommend using silver rather than gold for these short-term volatility plays.
Because silver has that dual nature identity, right? It trades as a monetary metal, but it is heavily tied to the tech and industrial sectors, which gives it those massive $3 intraday swings we talked about.
Precisely. It offers much wider trading ranges. Plus, depending on your trading platform, silver often features tighter bid-ask spreads relative to its volatility, making it mathematically easier to slip in and out of scalps profitably.
But the sources issue a massive blinking red warning light regarding leverage, don't they?
They do. The fastest way to destroy your portfolio in these specific market conditions is using high leverage. When gold is capable of dropping $40 in an hour to hunt stop losses, a heavily leveraged position will result in a margin call before you can even react.
Game over.
Yeah, you cannot chase price pumps and you cannot over-leverage. In a market, this sensitive, strict risk management and position sizing are the only real safety nets you have.
It really is a tale of two entirely different timelines right now. In the short term, the market is trapped in a pressure cooker. We are fighting algorithmic volatility, sector rotation into AI, and the constant heavy gravity of the Federal Reserve's interest rate policy. It is entirely possible we see gold test those sub-4,000 levels again before this cycle is over.
Yes, very possible. But when you pull the lens back and look at the macro structure, the foundation for precious metals has rarely looked stronger.
Right.
The geopolitical fracturing, the unsustainable sovereign debt loads, the shift away from the dollar, these aren't temporary anomalies. They are permanent realignments of the global economic order that fundamentally favor physical assets.
Which leaves us with a pretty profound contradiction to consider. If the entities that literally control the fiat money supply are quietly leveraging these price dips to stockpile massive amounts of physical gold in dark pools, while everyday retail investors are dumping their holdings in a panic over a single month's interest rate rumor.
It really makes you think.
Who is actually reading the room correctly here?
That is the defining question of this economic era. Does the true intrinsic value of gold lie in the volatile $100 price tags flashing in red and green on a brokerage app? Or does it lie in the undeniable reality of who is aggressively hoarding the physical metal while the rest of the market is distracted?
Spot on. When you see that market bungee cord snap, don't just look at the jumper. Ask yourself who owns the bridge. Right then, thank you for joining us on this deep dive. Keep questioning the algorithms, look past the daily noise, and keep exploring the fascinating mechanisms running behind the numbers. Please remember to like the video, subscribe to the channel, and comment with your opinion. We will catch you next time.